I'm John Zieger. I am the executive director, one of the co-founders of Responsible Innovation Labs. We're a coalition of ambitious founders and investors working to build enduring companies for the good of us all. And we work with some of the best venture capital firms and startup technology companies and LPs in the world, and are proud to be working together with them. I'll go ahead and introduce our panelists for this conversation. Stephanie Peng is the Chief Financial Officer of Transcarent. Previously, she served as the CFO at Teladoc Health, the Senior Vice President of Finance at Livongo Health, and the CFO at Vita Health. She was Chief Accounting Officer and Treasurer at Upwork. So not a small amount of experience there. Kyle Doherty is Managing Director of Investments at General Catalyst, a venture capital firm that invests in powerful, positive change that endures. Incidentally, an important partner of ours at Responsible Innovation Labs, and a firm that's been a real friend to us. Previously, he was the head of U.S. private investments at Coatue Management and a principal at Morgenthaler Ventures. Stacey Fagioli is Chief Financial Officer at Swoop Search. Previously, she was the head of corporate finance at Stripe, where she was a colleague of mine, and the head of strategic finance at Dropbox, and worked in banking and private equity. And the purpose of our conversation, so we are super excited, as you can tell from these folks' backgrounds, lots of experience with finance, with complex questions of governance and risk, and we're excited to learn from each of them. Each come with very different perspective and have their hands on different parts of the elephant, to sort of misuse that parable. The purpose of this conversation is to learn from each of our guests. What are you seeing and hearing? What practical steps should companies be taking now? And if we have some time in the context of the conversation, I'd love to reflect more broadly on how we think about risk. If you were like me, I invest in some companies and advise a number of companies. And in the few days that weekend after SVB had failed, I spent a good chunk of the weekend on calls with founders. What should we do? We had our funds, or a big chunk of our funds in SVB. What does it mean? Should we raise some money? Should we take some debt? What should we do? And we know that those conversations were happening, in manifold ways, all throughout the Valley. So we want to have the opportunity to learn and reflect on some of that. So let me start with the first question. And Stephanie, I'll point this one to you first, but in general, would love to kind of go around the horn on all of these, just sort of hear from each of your perspectives, if you have them. But just in general, where do you think we are right now with respect to the safety and soundness of the banking system? Is the moment firmly passed with SVB and the efforts to shore up First Republic, or is this just a lull in the storm and there's more to come? No one can know, but I'm just curious on your tea leaf reading on that.
Thank you for the question. It's a pleasure to be sharing my perspective with this audience. I still believe that the safety and the soundness of the banking systems in the U.S. is still very solid. I think that the Silicon Valley Bank situation was a little bit more unique because their business model was less dependent on the retail deposit than the traditional bank, and they are highly concentrated in the tech sector. Obviously, the investment they've made were very exposed to interest rate risk. There are a couple other regional banks that probably have similar risk, but I think broadly speaking, when you look at the top three banks in the US, they hold more than $8 trillion of assets. I do think that as I look at more from a practicality standpoint, especially for more early stage company, I think it's super critical that you evaluate the customer concentration, the banking relationship with who you work with, and also depending on how much capital you have. And the number one objective for all companies, especially early stage companies that are still largely dependent on VC funding, capital preservation is really important. Balancing the risk is also important. But I still believe that the overall banking environment is still solid. I think that we're going to continue to see kind of how the global economy is impacted in particular. But I think it's still healthy. I'd love for my fellow panelists to weigh in on this topic as well.
Yeah, I would say generally I agree with you, Stephanie. I think if there's anything that kind of came out of this is I think the federal government made it pretty clear that they'll protect the integrity of the system, even if it comes at cost, I think to a certain extent, because the integrity of the system, which is based on trust of businesses, small businesses to large businesses to consumers, is probably the most important thing. The thing I would sort of keep my eye on a little bit is if you actually look at the numbers, and FDIC is very transparent with a lot of the numbers around this, something like $120 billion moved out of banks that were not in the top 25 over the last month, kind of in the wake of this. So there is sort of potentially lingering concerns around trust in smaller banks. And as we know, SVB started as effectively a small community bank serving the technology industry. And there's lots of banks like that serving various industries all across the country. And so if there's implications for trust in the small banking system, which is very important for lending to smaller businesses and very particular industries, that's something to keep an eye on. And I know that that's something that the regulators and government want to make sure they maintain the integrity of, but there may be some trust issues around that to a certain extent. So, I think from our perspective, that's what we're watching from a macro perspective. But right now, it looks like things have stabilized. But the longer that we can keep this stable, I think time heals. So the perceived stability will be better as time goes on, but we're keeping a close eye on that.
Yeah.
I would agree with Kyle and Stephanie as well. And when the SVB sort of situation was starting to blow up, like in the CFO community, there was just so much chatter. There were emails flying around in forums, and private group chats were like blowing up as people were trying to figure out how to get a hand on the system. And just like on the ground reporting, I can say that that has pretty much completely died down. And so I think the near term sort of like panic is over. I agree. The Fed has like stepped in to kind of instill confidence in the overall banking sector. My sort of like super conservative CFO take is my personal belief is that as the effects of rapid rate hikes start to manifest in different parts of the system, like now there are some rumblings that commercial real estate will you start to see defaults in that area. I think there might be a steady drip of banking issues like SVB that get surfaced. And even though, we now kind of have more confidence that there will be some sort of, like backstop in the form of the Fed, I do think have this sort of steady drip of issues that could be sort of construed as being systemically destabilizing. It's just like fundamentally not great for the business environment. It's going to make it feel very volatile. It's going to continue to make the environment feel very contractionary. And so I'm like just continuing to sort of like proceed with extreme caution, just given sort of like this general environment.
Yeah. That's a great segue. I think maybe in light of that, sort of continuing sort of clouds on the system and that sort of risk and sort of instability. How do you, and maybe Stacey, I'll start with you on this, keep you in the hot seat for a second. How do you think about controlling for counterparty risks right now? What does good treasury, very specifically, what does good treasury management, look like right now? And what are practical things if people haven't done them? Obviously, lots of stuff has happened in the last few weeks. A lot has changed. But what should folks be doing? And how do you even think about diligence on your banking partners? What level? I think a lot of companies wouldn't have thought very much about this question. It's a little more pressing. Just general, what does good hygiene look like to you right now?
Yeah, I think I would assume kind of like given the audience, there's a bunch of sort of like fairly obvious stuff that has been sort of like talked about and implemented, such as, you know, having a sound investment policy, kind of diversifying your banking partners. I think one thing I personally don't really have the answer to is if you are a smaller company, you know, if you're a big company, bigger company, or, you know, you are a potential IPO candidate, it's very easy to get the attention of like tier one banks like Morgan Stanley and JP Morgan and Goldman Sachs and all of that stuff to be your counterparties. But if you are sort of like a startup that's really just like starting out, you know, sometimes it could be hard to get the attention of some of these like tier one or safer banks. I think, you know, there are a couple of large banks that have started establishing or building out startup practices, but it would be, I guess I'd be interested to hear from maybe like Stephanie or Kyle if there are good solutions there. That's like one thing I've been thinking about. And then I guess like beyond the sort of like nuts and bolts of good treasury management, I would say the other thing I think is important from a founder and CEO perspective is instilling kind of maybe the right culture and the right expectations of your CFO. I feel like in the last few years, in sort of like in a very kind of frothy and bullish environment, there was this sort of like concept, right? This rise of like the strategic CFO. And it felt like there was immense pressure within the CFO community to be viewed as very clever and very creative. And this even extended to functions such as like treasury, which traditionally should be just kind of run very conservatively. I remember there was a time when it became rather popular for CEOs to kind of like to ask their CFOs, hey, should we be holding crypto assets? And that, you know, to me, that's like not something you do to, you know, maintain like a low resting heart rate for the CFO. And so I think the cultural aspect is pretty important beyond a lot of these like nuts and bolts of good treasury management.
Yeah, FTX is not a good treasury management solution, that's for sure. So we actually, in the wake of the SVB event, worked with a number of other venture funds, and actually Stephanie was a big contributor to this as well, put out a piece with sort of very high level starting points for treasury management kind of in the aftermath of this. And I think there's sort of a framework we've used of, there's really three fundamental things you're doing. You're preserving capital, you're making sure capital is available and liquid, and, you know, kind of a distant third is you're generating yield or income. And kind of as rates have risen, that third part's becoming a bit more important because there's actually safe means by which to generate yield versus last 12 years, that really hasn't been available with kind of zero interest rates. And so within those kind of like that level of framework, I think capital preservation is the most important. And on top of that, it needs to be available. So we've been taking a very conservative stance around diversifying institutions, not going for yields, but making sure that capital is available at least for the next year across several different banks. And, you know, we've been kind of hitting that with most of the companies we work with. Most have actually already been doing that. Most have been pretty conservative about that. But as Stacey sort of highlighted, in some instances, there has been an increase in risk taking as, you know, things kind of really picked up and got a bit frothy the last number of years. And I would say those days are probably behind us at this point, but, you know, making sure that we remain conservative is very important.
Yeah, I totally agree. And I maybe just to kind of offer some of the leading practices that companies can consider. Treasury management sounds a little intimidating because obviously at a much bigger company, you know, they have a full-fledged treasury program. They do tons of investment, but I think it really comes down to just the standard internal controls that you ought to put in place regardless of the size of your company. And when I think about just cash management as a topic, my FP&A team obviously is very critical in terms of projecting like our operating cash flow, either it's receivable versus payable, just working capital needs of the company. I would say that given my background, I was raised by a banker, so I guess it's kind of built into my DNA. We do diversify our banking relationship even when we were smaller at the time. And I highly encourage that approach while the tier one banks may take a little bit longer to kind of warm up to companies at a smaller scale. It's worth the time, right? When they do the KYC process with you, you should do the same on them as well. Obviously, tier one banks, much less that we need to worry about from a liquidity standpoint. But obviously they have a lot of choices, but I would highly encourage to just take the time to establish the bank account. Maybe that's not your primary operating account. That could be your secondary. It's always great just to establish that banking relationship out of the gate. I think the regional bank or kind of more the tech-friendly financial institutions has been the go-to for many companies over the last 2 decades, at least maybe 4 decades. But I still think that just from a banking relationship standpoint, you probably want to choose a mix of tier one and regional banks who really know your industry really well and are very willing to be partners, especially when you have financing needs. I think some of the community banks are actually worth considering as well. Transcarent is huge on D&I. We're very fortunate to raise more capital since 2 years ago. We do invest our surplus, the capital that we don't need for operating purpose with some of these women-led investment platform or even just, minority-owned financial institutions. You'd be surprised. I think some of these community banks, while smaller in scale, offer fairly attractive interest rates. They are programs like CDARS, where 100% of your deposits are fully insured, right? It's a process they go through. It's like register agents where they go and find community banks that would, do kind of the pool CDs. I think those are really safe and ideal investment options if you have extra cash left. But I think just in terms of operations, the day-to-day operations, make sure that your FP&A person, your controllers are on top of your cash inflow and outflow. We actually have 5 financial institutions that we can manage our cash, but you should always have a primary. You should have 2 to 3 backups as your secondary that you can easily draw funds from. I also encourage that you establish banking relationship with the institutions that would be willing to extend a lending relationship, especially when there are needs that are unexpected. But I think that it may sound a little intimidating, like you need a big treasury team. You actually don't. I think it is really your finance team, your finance FP&A leaders, and your controllership leaders, and with just good hygiene from the start, it's worth the time to really establish those banking relationships.
That's super practical, and I wonder, just a follow up there. Let's just assume you're a relatively early stage venture backed company. You've got 20 months of burn in the bank. You've got a decent amount of money in the bank. It's well above the FDIC deposit limit. That's why I throw out some number like that. How do you think about, let's say you do have 2 or 3 deposit relationships, and that they're following your advice, Stephanie. How do I think about where I want to put that money, the relative buckets of money? Is it equal? And again, I'm trying to just be really practical here for early stage folks. How do you think about that question?
Yeah, great question. So I'm happy to share kind of how we manage our cash. I think it's always great that the company has at least a 1 to 2 year working capital projection on your operating needs versus your investment needs. I think that in terms of the operating account, you obviously want to make sure that in your primary and secondary operating account, you have 3 to 6 months of cash that's liquid, right? Because you should always plan for the unexpected. I think in terms of just taking advantage of the great high interest rate market that we have right now, there are plenty of safe investment, either it be money market fund that invest in U.S. Treasury bills that are super safe and very liquid. It's called a money market sweep account that you could probably establish with many of the banks, that the tier one or the top tier regional banks that you do business with. CDs are fairly attractive right now. You're probably getting 4.5 to 5% yield, and you can stagger it, right? Depending on your cash needs, you could stagger it, from 3 months to 12 months. I think that having the cash projection, that visibility, with our internal process on a monthly basis, we look at not just our P&L, our balance sheet, the health of the business. We also look at our cash projection, and we stress test, right? And so it's not, I would say it's not an extensive process, but I think it's a good conversation to first educate your team, especially your finance leadership and the people who are managing the outflow and inflow of the cash. And it's also a good conversation that you should always involve your board and just make sure that, you know, they're also comfortable with the broader cash management plan and investment strategy.
Yeah. Let me jump from the specific nitty gritty, which I suspect is probably most interesting to a lot of the folks tuning in. Maybe just to slightly back up to perspective on this current situation. I'm curious from your perspective, Kyle, as our resident venture capitalist. I'll turn this one over to you first, which is, how do you think about the role that VCs played in the downfall of SVB and this kind of bank, you know? It's a set of facts that's very particular, but you know, are there lessons learned, things we might be able to avoid next time?
Yeah, it's a good question, and obviously something as a venture community, I think a lot of people have been thinking a lot. You know, namely, was this avoidable? Was there a way to really stem the tide around it? And I think if you look at the nature of bank runs, they're really fundamentally a complex systemic issue. And what I mean by that is there's a lot of sort of interactions going on that make it really hard to sort of say any individual set of people, the bank itself, the managers of that bank are really to blame. It's very tricky because there's an interplay that's going on there. But actually, kind of a little funny aside, I think most folks on this call might know Ben Bernanke, who ran the Fed during the last financial crisis, 15 years ago. I actually won a Nobel Prize last year for a game theoretic model about bank runs. And the fundamental takeaway is once the word kind of gets out that there is the possibility that others could potentially pull their money from the bank, the rational thing to do is for you to pull the money from the bank. And I think we saw some of that advice being given out to founders kind of when this sort of kicked off, that Thursday morning. And so then the question becomes, if this were to be avoided, how do you get people to bond together? There's sort of it's the irrational thing that needs to happen, which is people standing together and saying, no, we're not going to pull our money. We think things are safe. And it becomes a coordination issue. And I think, with the number of companies and investors, all with exposure to SVB, that is a really difficult coordination problem to address, I think, at the end of the day. Now, at General Catalyst, we tried and we kind of banded together with a number of other venture firms to sort of take a public stand around SVB and the importance of SVB. But I think at the end of the day, once the snowball started rolling down the hill, it just kind of kept picking up more and more as it went down. And I'm sure folks have seen some of the numbers around how quickly things happen in sort of the digital age. Both information flows so quickly about this, and the ability to pull money or withdraw money can happen so quickly with online banking that this was sort of the first digital age bank run, at least, that we've seen. And it just became a really difficult situation. So, what role did VCs in the tech industry play? I mean, listen, everybody was a participant in this to some degree or another, but, the incentives make it a really difficult, challenging problem specific to bank runs. And so, the lessons to be learned, just to generalize it a little bit, I don't think anybody, even just a couple months ago, and there were some journalists writing about, some problems with SVB in particular in the financial system, but this was not something being talked about at a board level or at most companies, that this was a potential risk. And so the generalizable risk takeaway is that risk lies around every corner. And so kind of thinking through processes to react, even when you can't predict what's going to happen, can be an important thing. And I know we're going to kind of get to that in a little bit here, but I do think that this was a very difficult situation for everybody from company CFOs, CEOs to investors to, the bank itself, who you could make the argument that there could have been better communication around what was going on, with their need to raise capital and some of the things that potentially kicked this whole thing off. So,
yeah. Others can feel free to chime in on that question, but I'll bridge. Kyle, you sort of set me up nicely for the next question I was going to ask, which is I think related to that, which is what lessons from this this particular crisis for dealing with what I would generally put in the bucket of tail risks, unusual large risks that don't occur frequently, but when they do, have a severity that is, potentially company imperiling. In the last 3 years, we've had a once in a multi-generation global pandemic that brought the global business environment to a standstill and produced kind of changes that none of us had ever experienced before. Obviously, the SVB failure of a much smaller kind of global magnitude, much more localized, but of very substantial significance. So, there are two examples. Undoubtedly, the next tail risk will not be one of those. So, but I guess maybe Stephanie, I'll sort of throw this one to you first, and I'd really love to hear from everybody on this. How do you think about planning for the almost the unplannable in some ways, these tail risks? What level of margin do you what capacity do you want to have? What are good processes that you go through? Just your general thoughts.
Yeah, great question. I think that regardless the size of the company, I think having line of sight on your business continuity plan, especially for your critical processes, having a framework on how you manage enterprise risks are super critical. A lot of the companies don't have the resource and the knowledge to build in a full-fledged enterprise risk management framework. However, I do think that it's always good to start with focusing on the most business critical areas and making sure that your board truly understands what are the plans, the process, and the systems that you have put in place to mitigate the unexpected. I think specifically when you look at kind of early stage company, the risks are probably more obvious, right? It's, externally, your, cyber, customer and PR risk. But internally, I think each functional leader should have a pretty good list of, what needs to happen to keep the lights on, what needs to happen to make decisions and how to communicate, how to navigate and how to mitigate these risks. I think it'll be worthwhile to really build in as part of your monthly management plan as, you work through some of these, scalable issues and, building the companies and pivoting, in different areas across the organization. It's worth the time and the energy to really lay out the enterprise risk process and incorporate others to your ongoing board dialogue.
Think about tail risks and good process and planning for them.
Yeah, I think Stephanie covered the risk management and business continuity aspects. So maybe I'll chat more about like the capital availability aspects, which is just like stress testing your model, right? Like really stress testing it. And I'm currently at a much earlier stage company than I was at Stripe, and so I definitely do this a lot more, especially if you're not in like a SaaS company with very sticky recurring revenue streams with a diversified customer base. Like Swoop, we have massive government contracts, so really building into your like stress testing in the model. What if this contract just took 2 months longer to cross the line? What if this contract took 3 months longer? What if it came in at, a different value than we thought it would be? Like keeping that framework in mind when we're making capital allocation decisions. Like, are we going to invest in, do we want to invest in this new product line X? And what does the return time frame look like? And is that something we want to do given, like this like bear case scenario? So just doing a lot of stress testing. It's not a crystal ball. Like unfortunately, I can't tell the future, but it does, I think, help everyone on the management team just be a little bit more like rigorous, perhaps, in their thinking of, okay, well, every day we're spending money. Is that, is that a good decision? And then this is more something I saw at Goldman, which is at Goldman, risk management was very much viewed as like a first-class citizen, meaning that it was structured such that, you know, the head of risk, or, you know, whatever the title is, did not report into someone who's like a revenue generating leader, because then there could be sort of inherent tensions in terms of, okay, the revenue generating leader has to make the difficult decision of like, do we generate revenue or do we manage risk? And instead it reported like directly into the CEO. And so everyone sort of in the firm knew that risk management was inherently like was inherently a key stakeholder if they wanted to get any deal done, or any sort of like risky deal done. Of course, we can kind of like debate whether that actually worked, given some of the, you know, like scandals and whatnot that have emerged. But it was at least a culture that the firm strived to instill, which is just always you know, keep risk management in the back of your mind. Don't sort of feel like, don't view finance and legal and risk as like your enemies, right? They're not the enemy. They're not the ones who are trying to hamper growth. They're just trying to make sure that we're growing responsibly and not taking on outsized risk.
Kyle, thoughts?
Yeah, I mean, I just think from a board perspective, if there is a tail risk that is unexpected, I think the main thing a board cares about is around decision making, that communication is fast, it's precise, and it's urgent, and sort of shows that urgency so that everyone knows we need to get around the table and problem solve this. And, you know, there's probably thousands of tail risks. You can't predict them all. But as long as you have communication processes in place to react appropriately, that's sort of the best you can ask for at the end of the day. And I think from a board perspective, most board members really appreciate over communication instead of under communication if any of those risks do hit. I think this was a situation where, with SVB in particular, it was so present across the board that, you know, every venture person was reaching out to their portfolio, asking, you know, about exposure, and sort of communicating bidirectionally. If there's a very specific risk around your company itself and now it's more systemic, you know, there needs to be that communication. You know, folks need to be kind of kept in tune so that they can actually help. And you never know, you know, having more eyes around the table can help sort of assess and come up with solutions for what you should do.
Yeah. Yeah, I'll take moderator's privilege here to throw in a few reflections on some of what we did at Stripe here, because I think some of it was good process and maybe fleshes out a little of what each of you you know, are talking about. We ran a process, and it started probably 4 or 5 years into the life of the company. So it obviously wasn't very early stage, but at a time when we had some fairly substantial scale, where we would identify tail risks periodically. Our ambition was to do it quarterly initially, and we would rank you know, our kind of 10 biggest risks to the company, and a bunch of them are sort of obvious, right? A data breach, you know, a significant regulatory problem. They did include some financial partner, you know, problems. So, but various things, and necessarily, you know, I think risk management, you know, as you say, I think maybe paraphrasing Dwight Eisenhower, that, you know, the plan is nothing, planning is everything, right? The reality is, like, the risks you identified are almost certainly not going to be the ones that manifest in precisely the way you identified them. But the act of identifying them and the act of going through, and we would write up, so to be clear, what we would do is identify the top risks. And for the very top ones, we would actually write up little scenario papers. They were almost little stories about how this would go down, what the impact would be. And it allows you to get into the space of imagination to figure out who needs to be in the room, who do we need to consult, where are the holes? And as you start to expose that to a little bit of a bigger group, you begin to build a little bit of the at least conceptual muscle. You know, this is maybe a little bit like a free throw shooter, kind of imagining the shot over and over again, right? It's a bit of training yourself. And when we did have substantial risks, obviously some of those processes were informed by actual risks that had manifested, and we kind of extrapolate from them. but when we did have substantial risks, it was really quite helpful. And we instituted a number of different, we had a thing called the Big Red Button, which was a sort of system for identifying, getting a bunch of people immediately to pay attention to an issue. We had a number of different processes like that. But I guess I identify it because I do think engaging your management team, engaging your leadership in the exercise of imagination and planning, even if fairly, kind of periodically or episodically, it doesn't have to be all the time, has real value. And I would encourage you, even at a fairly early stage in the company, you can do that. And so, that I think was a particularly good practice. I guess let me ask you a sort of a different question, and Kyle, I'll throw this one to you. As a board member, as someone thinking of, about this from the perspective of an investor, at what point in the life of the company do you think companies should be thinking about the less immediate risks? Obviously, Stephanie, I think initially you're caring about closing the immediate deals on your that are in the pipeline and hiring and all of those things that are right in front of you and that are critical path. That makes sense, and certainly for a period of time, that's going to be all you have space to focus on. But when do you begin to broaden the aperture to think about things that are a little bit longer term risks?
Yeah, it's an interesting question, because most of the advice that people will give for an early stage company, let's say anything from seed through a Series B, is there's really simply two things you're focused on. You're building a product and you're trying to sell a product or get distribution for that product. And everything else should kind of fall by the wayside because you have limited resources. You need to figure out a way to make it work with that limited resources. So it becomes sort of a difficult prioritization exercise around where not only you spend sort of either monetary resources and whatnot, but where people spend their time. And so, there's a trade-off that kind of comes sometimes if you spend a lot of time on things that aren't, to that core. At least that's sort of the typical advice that gets dispelled. Our view has been that, it is worthwhile even just doing very simple, short exercises with the team to think through where some of these risks may lie, as you sort of talked about just now, John. And that can start at the very earliest of stages for a Series A company. But in terms of actually implementing process, what we've typically seen with companies, it's when you reach sort of I call it Series C or Series D stage, where the money, the capital that you raise, the stakes get a bit higher, you have customers, and you're forming yourself into a high growth company that has its sights set on maybe someday we'll be a public company, or we're now seeing the things come together where we think that this is going to be a real meaningful product and a business of scale. And kind of it's hard to say the exact moment, but kind of in that Series C stages where we've seen people start to take that a bit more seriously, start implementing and hiring out a finance team that has a bit more maturity, thinking about a CFO, potentially putting together an audit committee for the board level as you think about those next steps. And so, the key question now becomes, should you start doing that a bit earlier? And I think, the prioritization should be around maybe doing some of the simpler things earlier and not necessarily needing the full processes, but making sure it's top of mind for people such that if those risks do hit, people are mentally prepared for them.
Yeah. Now, Stacey, you are at an earlier stage company, so you're very much that's your reality right now. How do you think about that?
Yeah. I kind of generally agree with Kyle that Series C is when companies start to do sort of put more concerted effort around building out, risk management programs and whatnot. I think the way I have thought about it in earlier stages, we're much leaner. We're definitely in the phase where, you're either building a product or selling a product. And those are the most important activities. So I guess one thing I have done is, and Soup is obviously it may not be the case for other companies, but our CEO was pretty, he did not like insurance, or he did not believe in paying excessively for all sorts of insurance, cyber insurance, D&O insurance, general liability. And my philosophy was sort of look, you can do the math, right? Like your premium will only increase by X%, but your downside is kind of like protected. And I think given sort of like some of the events that have transpired in the last 2 to 3 years, it's actually maybe a little bit easier now to make the case that it's worth spending a little bit more to protect your downside. And so given an absence of like internal resources to be managing these things on a day-to-day basis, let's, have some like insurance coverage to protect our downside. Yeah, I think that's kind of most of it.
Stephanie?
Yeah, this is a really fascinating topic. I actually think that at earlier stage companies, I think you have more single points of failure. I actually think that it's also more transparent, right? Meaning that they don't have a CFO, they probably have one finance person who may or may not at the right level to make all financial decisions. So this is where the founders and all the C-levels, probably even the board, the main investors would be much more involved, right, in making the strategic decisions. I think that earlier stage company, the risks are bigger, but they're less, right? Because obviously it's, capital, right, being number one, and product, are you able to commercialize the product you're building? Because, there's just a lot of investment, right? And a lot of really big and key decisions that need to be made upfront. I do think that the concept, the principle of how you surface the risk, how you manage the risk, how you make decisions on the risk may change over time. But I think that the visibility is important. Talking through these risks is important. We do a weekly executive team meeting. We do monthly business review meeting. We do quarterly business review meeting. I wouldn't say we're super late stage, but I think we have a lot of team members on the team who came from bigger companies. It's the discipline that you build early on that really will pave the way. I think surfacing the risk is important. The trick is how you prioritize, how you allocate resource, right, to mitigate these risks. I do think that, especially earlier stage, I think it requires more energy to prioritize. But as you start to scale the company, I think the concept of internal control, risk mitigation, and even for companies who are much more ready to do Sarbanes-Oxley, all of that, I think really depends on the stage of the company. The fundamental principle doesn't change. I think you just need to pick your battles, but make sure you do focus on that. But I do think where a company probably fall a little bit short is communication. It's managing the risk, right? Who's deciding the risk, right? And what tools, what resource, and what levers you can pull to mitigate the risk and the right risk. I think that I would think that depending on the company, the stage and the experience, I think that your investor and the board could be very helpful, especially when the company is just building out the product and in a more of an early stage. But once you get through kind of the commercialization stage, mid to late stage, like what Kyle said, you absolutely need to invest the time and energy. I think quarterly business review is a really important process that not only you celebrate your successes, make sure you talk about the risk and how you mitigate the risk and what kind of investment you would put and invest over time to build the operations that really will get you to kind of the end state that you wouldn't have to end up rebuild or mitigate.
I will just, those are terrific comments and very useful. And I'll just kind of echo, because you said something there that I think is just really super, super important to risk management generally, which is knowing who owns the risk. I think a lot of the biggest risks in companies end up being practically unowned, or the assumptions are made about who the owner is, but that person doesn't necessarily think of themselves as being accountable for it. And once you go through a process to identify who the owner is and to have some kind of periodic check-in on that risk, the sense of accountability drives focus, and focus drives preparation, and preparation puts you in place to have better outcomes. So I think it's a tremendously important kind of point about kind of organizational sort of psychology and dynamics. It's just having a named owner. And that will obviously, as you begin to get an audit committee of the board and other things, that accountability will increase and you'll have more. But I just want to echo that because it's really important. I'm going to ask one more quick question, then leave a little bit of time for some audience questions, and I've got a couple of others if we get to our audience questions quick. Just very practically, this is a moment of change. Lots of folks are moving money around. Money that big piles of cash that's out in one bank are now being spread around to multiple banks as everybody gets religion about diversifying their financial relationships, and that strikes me as creating some risk, and there probably are other unforeseen risks. So just your quick kind of practical tips about this moment right now, about just what's changing and what people should be thinking about that they might not otherwise have top of mind. And Kyle, I'll turn to you first.
Yeah, absolutely. Yeah, this has been a big thing that we've been talking with companies we work with quite a bit, and that is actually very particularly fraud risk. Because so much money has moved in such a short period of time, like literally on the orders of billions of dollars, it leaves companies open to, if they don't have the appropriate processes in place, to potentially make mistakes on where the money gets moved to. And that can come across in a number of different forms, whether that is, a fraudster sending an email to a CFO pretending to be the CEO and saying, hey, we're actually opening up this account at this place, send it here. And it turns out to be a Cayman Island bank account that, you never see that money again. And there is historical precedent to this happening to tech companies years ago. And it is sort of a known risk that can occur. So a lot of companies, particularly on the more mature side, will have policies in place around verification via phone, having, at a minimum 2 people to, approve any movements of money above certain levels. But this really opened up the potential for fraudsters to take advantage of it. Another potential risk area would be around vendors. A lot of tech companies that you're paying on a monthly basis for their software, whatever it might be, you could get an email from a company saying, hey, we moved bank accounts, please send your monthly payment to this one instead, and ends up being a fraudster who is pretending to be, your rep from, name your software company. And so we're telling our companies to be cautious about this and be aware and implement processes around major money movements to make sure you don't get caught on the wrong end of that. To be clear, I have not heard of any specific instances around this, but to be fair, this is typically something that people try to keep quiet if it does occur. So it may be occurring, we don't know, but we do think that the risk has increased dramatically given how much money movement has happened. So we want people to be cautious about that.
Great. Stacy, any other things that are on your mind? Just practicalities.
No, I think Kyle kind of covered it. And then there's some kind of, practically speaking, internal operations wise, just making sure that, with some treasury functions are automated. So making sure that everything is sort of rewired and set up for this new kind of world with multiple banking partners.
Stephanie?
Yeah, I agree with both Kyle and Stacy. I think segregation of duties is important, making sure that you stress test your internal process. There's a clear decision tree. Communication is super critical. I think especially when multiple constituents are involved, just making sure that it's clearly communicated. But I do think that for companies with a much smaller finance team, lining up backup plans, even just executive outside of the core finance organization that have access, and there are ways, especially in the digital banking world, there are ways to protect who initiates versus who can approve funds going out. I just think that it's important to kind of lay out that segregation of duties and business continuity plans so that you don't have just single points of failure.
Well, that's super helpful. Let me turn to a couple of audience questions here, and then if we get through those, I've certainly got a number of others for you all. So the first one is from Aaron, and the question is: in the wake of SVB, have VCs, and maybe I'll take just broaden that to VCs and board members, become more independent board members, become more actively involved in helping portfolio companies evaluate treasury and counterparty risk, and or leveraging their relationships to provide solutions to those risks. For example, getting new bank partners involved, diversifying relationships. What's the role of VCs and board members in those processes? And I will open it up to any of you. Kyle, feel free to jump in.
Yeah, no, absolutely. That latter part in particular was a very key part of what I think a lot of investors were doing, kind of directly in the wake of what was going on with SVB, and then sort of ripple effects with First Republic and some of the other purported banks, to the companies that had exposure around that, and even some of them that didn't necessarily have direct exposure, but just kind of rethinking through, should we work now with a JP Morgan, or name your sort of systemically important bank at this point. And so I think the number of introductions made increased dramatically. People sort of trying to provide leverage. I believe somebody made the point earlier, I can't remember if it was Stephanie or Stacy, that if unless you're big, a big bank might not care as much about you. They need large capital for it to matter for them, and so to put resources towards providing good customer support or service. One of the things that I think a lot of investors did a very good job of was leaning on these banks to say, hey, no, you need to provide, even though this is a small company, you need to provide them better service than this. Help them get this bank account opened within a day instead of 3 days, and make this a priority. And I thought it actually was quite effective because sort of the investors could aggregate the quote unquote buying power of an entire portfolio as opposed to one individual company. To sort of lean on them and try and provide better service for their companies. I think that on a go-forward basis is something a lot of investors are thinking about. And I think it's generally, as a board member, thinking through treasury and risk management is always something that is it's a part of the job, not only for, if there's an audit committee set up, but for everybody at the end of the day. And so it's always been a core piece of the function of providing governance as an effective board member, whether you're an investor or an independent board member. And so this really brought to light, some of the potential risks that can come up from that. And so I think a lot of boards are reassessing very specific things around investment policy, thinking through who it is on the team that is, responsible for various parts of treasury management, and actually implementing audit committees earlier than they otherwise normally would on the life cycle of the company to make sure that they're staying on top of it.
Yeah, I was gonna say, and through this episode, I have sort of become more proactive too in reaching out to my board and just pinging them on these topics of risk management, because they are, SVB is a small company. We don't have an experienced treasurer, but the investors, they get to see a much broader they have a broader portfolio of companies. And, Kyle, you would have seen some Stripe with world-class treasury management and lots of ex-Goldman, alums sort of handling finance and treasury. And so kind of tapping into that broad knowledge base that a lot of our board members and investors have, I think has been extremely valuable.
Yeah, totally agree. I would probably just add a couple points. I actually think that the tier one banks are much more friendly to do business with now, given, they do have more automations. They're able to really push through some of these, account management, prep work systematically. I would highly encourage, I think in addition to your board and investors, you could always leverage the peer group, right? Either be, another companies in the same portfolio, or through your auditors, through your legal counsel. There's lots of ways to get introductions to the right banker. I think at the end of the day, my experience been, it's less of the bank themselves, is how they get you connected, right? Don't stop by the branch to open a bank account, right? Because that's for the retail market. I've seen that done, and not joking. And it's just, you're connecting to the wrong group, especially these tier one banks. They have, many system and platform that depending on the size of your company. So take the time to share your banking activities with them. Take the time to explain, short term, what do you need today? But don't get stuck on just today, right? Lay out your plan, your long range plan. What's going to happen in 6 months, a year, and 2 years? They will invest in you. And my experience has been fantastic, as a matter of fact. Maybe it takes a little bit longer. Maybe it takes a month to open the bank account, but that's okay too. I mean, make sure you land on the right solution. It'll pay off. I do think that, in terms of just the day-to-day operations, I think of it as you're managing your personal finance, right? I think having finger on the pulse on a monthly basis, making sure that you also understand the kind of the overall health of the business and just your cash leverage. making sure that you have a clear communication channel with your customer. I mean, oftentimes it has nothing to do with the bank itself. It's maybe just a communication breakdown between your customer, which is your receivables are not coming in. I think your disbursement partner is super critical. The account manager of your payroll systems, of your disbursement system, maybe use bill.com or Bricks. They have been super helpful. We didn't need the help, but I've seen them stepping up to really help companies in needs. And so making sure that you always have a backup plan. We tend to plan way ahead, but don't just have a plan B, have a plan C and D, just to make sure that your team are fully ready and fully prepared to manage all unexpected circumstances that arise.
Great comments. We've got more questions than we can probably handle in the time that we have, and I want to leave just a minute or two for one question. I think is a quick one that will hit. Carrie Bresnahan asks, how important is legal counsel to the board regarding risk management? I have some perspective on that, but happy if you. I'll 20 seconds for a quick answer from whoever wants to take it, and then I'll leave just a couple minutes for last comments.
I can jump in and give a quick answer. So we've been very fortunate. I think we've had great advice from our outside counsel as well as from our auditor, but my GC and I tag team to build an enterprise risk management plan. And we do collaborate very closely with our board to get input. Early stage, we did more of an update, right? Here are the risks. This is how we're looking at the risks and when we're going to mitigate the risk. As your organization matures, then you have to start rolling out plans and how you really mitigate that and how you communicate the risks.
Yeah, I'll just add as a longtime general counsel, super important. I think important in moments of real crisis to get your outside counsel involved as well, because you want to have that extra advice. Ultimately, if it goes very south, you're going to want to have the capacity of a law firm and other resources at your disposal. But I think a critical partner to the CFO in mature risk management processes, as you say, not necessarily at the very beginning. We are almost at time, so I want to give any last thoughts on this topic from any of you all, and on any of the things we've hit, things you wanted to say that you didn't get a chance to.
I think we covered most of it.
Okay, well, with that, we are just about at time. So I will say these were great practical comments, lots of things for us to learn. We will do a bit of a summary of this, kind of distill some of our key lessons learned and other thoughts and share them with our community. This recording will be available for others to watch as well. So we're excited to be able to inform folks with this really practical conversation. I can't thank you all enough. Great conversation. I knew this was going to be a good group of folks, and it has lived up to that. So thank you for doing it, and we will talk to you again soon.
Thank you.
Okay, cheers. Bye-bye.